Hey there, future investors. Welcome to the channel. We're thrilled to have you here. In today's video, we're diving into the stock market, breaking down everything you need to know in just under 9 minutes. We'll cover the basics, the essentials, and even some advanced tips to get you started on your investing journey. Whether you're a complete newbie or just want a quick refresher, stick around because we're going to make the stock market fun, simple, and easy to understand. We'll break down complex concepts into bite-sized pieces so you can grasp them quickly and confidently. Ready? Let's get started. So, what exactly is the stock market? It's a fascinating place where fortunes are made and lost. It's basically a huge marketplace where people buy and sell shares of companies. Think of it as a giant auction house, but for pieces of businesses. When you buy a stock, you're owning a tiny slice of that company. It's like owning a piece of a pie, and the size of your slice depends on how many shares you own. If the company grows and makes money, your share grows in value too. It's that simple. But remember, the opposite can also happen if the company doesn't perform well. But why would a company sell its shares? It's a strategic move to raise capital. Simple. When a company wants to raise money to grow, whether it's to build new offices, launch products, or expand, they sell pieces of ownership in the form of stocks. This influx of cash helps them achieve their goals faster. It's a win-win. The company gets cash and you, as an investor, get a chance to profit from their success. Plus, you get to be part of their journey. Now let's talk about how stock prices move. This is where things get interesting. Stock prices are influenced by supply and demand, but they can also be affected by a company's earnings, market trends, or even news events. For example, a positive earnings report can drive prices up, while bad news can send them plummeting. When more people want to buy a stock, the price goes up. It's a sign of confidence in the company's future. When more people are selling, the price drops. This could be due to various reasons, like disappointing earnings or broader market fears. It's like an auction. Prices fluctuate based on what people are willing to pay. The market is constantly in motion, reacting to new information. You've probably heard the terms bull market and bear market thrown around. These are key concepts in understanding market trends. A bull market means stock prices are going up, investors are optimistic, and the market is strong. It's a time of growth and confidence. A bear market is the opposite. It's when prices are falling and investors are nervous. It's a period of decline and caution. Bulls charge upwards and bears swipe downwards. Easy to remember, right? These terms help describe the overall mood of the market. Now let's break down the two main types of stocks. Understanding these can help you make better investment choices. Growth stocks are from companies that are growing fast. Think Tesla, Amazon, or your favorite startup. These companies are often at the forefront of innovation. They usually reinvest profits to keep growing and don't pay dividends. This means they're focused on expanding their business rather than returning profits to shareholders. On the other hand, dividend stocks are from established companies like Coca-Cola or Apple. These companies have a steady stream of income and share a portion of their profits with investors. They pay regular dividends, which is a way of sharing profits with investors. It's like getting a bonus for holding their stock. Growth stocks have higher risk, but can offer huge returns, while dividend stocks are more stable. It's all about balancing your portfolio based on your risk tolerance and investment goals. Ready to buy your first stock? It's an exciting step towards building your financial future. Here's how it works. First, you need to open a brokerage account. This could be with apps like Robinhood, E-Trade, or Fidelity. These platforms make it easy to start investing with just a few clicks. Once you're set up, search for the stock you want, enter how many shares you'd like to buy, and boom, you're officially a stockholder. It's that simple. You can start with just a few dollars with fractional shares if you're new to the game. This allows you to buy a portion of a share, making it accessible for everyone. Now here's the deal. The stock market can be risky. It's not always a smooth ride. Prices go up, but they can also come crashing down. It's like a roller coaster. The key is to stay calm and not let emotions drive your decisions. That's why it's important to only invest money you can afford to leave in the market for a while. This way, you won't be forced to sell at a loss during downturns. Stocks are best for long-term growth, so don't panic if prices drop. It's part of the game. Over time, the market tends to recover and grow. Here's a secret every smart investor knows: diversification. It's a strategy to spread your risk. Instead of putting all your money into one stock, spread your investments across different sectors like tech, healthcare, and consumer goods. This way, you're not overly exposed to any single industry. This reduces your risk because if one stock drops, your entire portfolio won't take a big hit. It's a way to balance potential losses with gains. Think of it like not putting all your eggs in one basket. Diversification helps protect your investments from market volatility. If picking individual stocks seems overwhelming, there's an easier option: index funds. These are a great way to invest without having to pick and choose stocks yourself. Index funds are a basket of stocks that follow the performance of an entire market index, like the S&P 500. They offer broad market exposure. Instead of betting on one company, you're investing in hundreds of companies at once. This diversification reduces risk and provides steady growth. It's a low-cost, low-maintenance way to grow your money steadily over time. Plus, they often have lower fees compared to actively managed funds. Next, let's talk about strategies. There are different approaches to investing, and finding the right one for you is key. Some people try to trade stocks short-term, buying low and selling high within days or weeks. This is known as day trading, but be careful. This is risky and takes skill. It requires constant monitoring of the market and quick decision-making. On the flip side, long-term investing is where you buy and hold stocks for years, letting compound growth work in your favor. This strategy is less stressful and has historically provided better returns. Historically, long-term investors see better returns with less stress. It's about patience and letting your investments grow over time. To be a successful investor, you need to stay informed. Knowledge is power in the stock market. Use apps like Yahoo Finance, Bloomberg, or CNBC to track stock prices. Read the latest news and watch market trends. Staying updated helps you make informed decisions. Set up alerts for companies you're interested in and follow industry experts for tips and insights. This way, you'll be the first to know about important developments. Here are some final tips for stock market success. Start small. Don't feel pressured to invest big at first. It's okay to begin with a modest amount and gradually increase your investments as you gain confidence. Be patient. The market rewards those who hold on for the long term. Remember, investing is a marathon, not a sprint. And lastly, stay consistent. Invest regularly, even if it's just a little bit each month. Consistency helps you take advantage of market fluctuations and build wealth over time. Thanks for watching. And if you found this video helpful, don't forget to like, subscribe, and drop any questions in the comments below. Happy investing! Subscribe for more tips on investing and building wealth. We're here to help you on your financial journey.